Hello, everybody. Welcome to Talk About Houses. I'm Todd.
I'm Juana.
This is sort of our big finale for the year. This is the 2023 outlook, and this is a summation of all of the top investment banking companies in the U.S. Goldman Sachs, JPMorgan, Citigroup, Wells Fargo, sort of everybody. And we're going to go through all these, and we're going to talk about them, what their projections are for 2023, with an emphasis on real estate.
Right. So if you like data and if you like this sort of conversation, please subscribe, hit the notification bell, like the video, share the video, and leave us a comment. Tell us where you're watching from. Let's go.
Okay, so the focus on this is going to be what's going to happen with inflation, what's the Fed going to do, what's going to happen in real estate, and then the chances of recession.
Yes.
Okay. So the first we're going to do is Goldman Sachs. Now, we read through these, and some of these were substantial. They were like, one of them was 127 pages. It was a lot of data. They even did global and things like that. Okay. The global economic analysis for 2023 was the headline of the thing caught my eye. It's the cycle is different. Mm-hmm. Because we normally have these expansions with small contractions, expand, small contract, expand, small contract. But this is substantially different because all of you know the last three years have been very interesting.
They've been interesting and they've been historical.
They have been historical. What I think caught my eye was this was one of the better. We're just going to, because some of these aren't as good. Some of them are more negative. But this is one of the better ones. And I'll put up the first little thing here. The U.S. should narrowly avoid a recession as core PCE inflation slows from 5% now to 3% in late 2023, with a half percentage point rise in the unemployment rate. To keep growth below potential amidst stronger real income growth, we now see the Fed hiking another 125 basis points, which is 1.25%, to a peak of between 5 and 5.25%. We don't expect cuts in 2023. They don't expect the Fed to cut. They just think they'll just sit on the rates. Okay, we'll go through two of these numbers really quick. 3% inflation is certainly a little bit above the Fed's target of 2%. Mm-hmm. But what about unemployment rate of only going up half a percentage?
I think that they're missing the mark on this one. I think unemployment will go up a little more than that. I don't think it's going to be rampant. I think it's just going to go up a little bit more than that. And the reason isn't because I have some magical formula, but it's just historically looking at historic low unemployment rates can't last forever. And I think that 2023 will be the year where unemployment does tick up a bit. I don't think it's going to be something particularly dramatic.
Okay, the other thing here that's interesting is if they don't expect cuts, but if they think that the Fed rate, it has some limited thing, this is good long term for real estate because real estate mortgage rates don't go based on as much the Fed rate, but what they see happening with inflation. They need to be able to beat inflation in the long term. And if we're down to 3% or below inflation, we could potentially get back to 4.5%, 5% interest rates, which would be pretty fantastic.
Right. So you make a really good point. Mortgage interest rates are based partly on what's going on with the Fed and partly on what's going on with inflation. As far as what's going on with the Fed, those rate hikes have already been baked in to the current mortgage interest rate environment. As far as the inflation is concerned, I think a lot of that has already been baked in as well. Mortgage rates will probably still go up a little bit, but not much. And certainly they will not match, they're unlikely to match the Fed's 1.2% or 1.25% rise in interest rates. So we're not looking at 7.5%, 8% in interest down the road in 2023.
Yeah, actually, it's funny because the last Fed increase, interest rates went down like 0.7%. So the Fed raised rates, but mortgage interest rates declined. Right. So they're separate things. They're not tied to each other.
Well, but the reason that they declined is because at the same time what came out was the inflation rate.
It was much better.
And it was much improved. So that made the mortgage bankers say, hey, we see more stability going on with inflation. So we're taking that into account as we're calculating the mortgage interest rate that we need to charge in order to be profitable on these loans.
And then keep this in mind too. that federal funds rate is an overnight bank for Federal Reserve banks that borrow, and mortgage lenders are loaning for 15 to 30 years. They're not borrowing. They're not loaning and saying, well, we have to make 5% over the next 30 years because it's a market, so they have to be competitive.
Right.
Okay. Here's the very interesting thing that I found from this article, and then we'll move on to the next one. U.S. likely to avoid recession. So here's the thing. In the beginning of 2021, there was an extremely high probability of a recession in 22, which never materialized. Remember all the calls of a recession third quarter was supposed to happen third quarter, it didn't happen. And then by the middle of the year, there was a 100% chance we would have a recession in 2023. Well, now it's of all the people that have guessed whether we have a recession or not, it's 65% chance. Okay. And all of them only said there would be 2 quarters. Like we would literally just have 2 quarters of negative growth and then it would go back.
Right.
Every single one. So 35% said no recession, 65% said 2 quarters, and then that would be it. Which I think is interesting because most of it was the first 2 quarters of the year, which would be great because that means we're like almost through it.
Right. So I agree that the first 2 quarters of the year are going to be rough. Yeah. The third quarter I think is going to be a push. And as far as the recession or not, we've redefined what it means to be in a recession this year. So I'm not even going down that road.
Okay. Well, so in the past year, U.S. growth has slowed to below potential pace about 1% because of a diminishing reopening boost, declining real disposable income driven by fiscal normalization, high inflation, and aggressive monetary tightening. In our forecast, growth remains at roughly this pace in 2023. Now, this is what's most interesting. Unlike a year ago, when our forecast for both 2022 and 23 was below consensus, so they were more pessimistic in their estimate compared to other people, we expected a negative impact of monetary and especially fiscal tightening. Our current 2023 forecast is well above consensus. So they flipped. They were super pessimistic beginning of the year. Now they're super optimistic.
Right. And I agree with them. I am optimistic for 2023 because I think we've already gone through a good bit of the pain already.
Yeah, I think we have to. Now, what we're going to show you that next is we're going to focus on this one on the left. This is the most important thing on here that you're going to see is the little red dot. The little red dot is real disposable income. Now, as most of you know from watching our videos, only 4% of all disposable income in the U.S. goes to make mortgage payments. We pay very little of our disposable income as a nation because a lot of people own their house free and clear, or they have they don't owe very much on the house. They don't have a very large payment,
or they've had the mortgage for a long time, so that mortgage payment is pretty low.
Yeah, the mortgage payment's low, or they had a really low interest rate at one point. But what's interesting is this little red dot, as you can see where we are here, it's been improving every month. Disposable income has been increasing, and it's going to break back above that, percentage change from December of 2020. So we see disposable income, or they see it improving, and that's great for housing because if people have more disposable income and people have jobs, then they're still buying real estate, and that certainly doesn't mean home prices will go up, but it certainly caps a lot of potential downside.
Well, and that increase in disposable income also means that people are engaging in commerce, which again relieves some of the fears regarding unemployment and recession because there are transactions taking place.
Yep. Okay. The next one we're going to do is JPMorgan Asset Management. This is the branch of JPMorgan that's managing all assets of all asset types for their clients. Obviously, they're making global decisions. And yes, the whole world, but then they have to make decisions on where to place money across all potential investment vehicles but to maximize the value for their clients. Here's the first thing about housing that we ran into. Housing markets are, as usual, the first to react to central banks touching the monetary brake because of mortgage rates. Materially higher new mortgage rates are crimping new housing demand, and we think the ripples of weaker housing activity will permeate through the global economy in 2023. Construction will weaken, which we've seen. Spending on furniture and other household durables will fall, and failing house prices could weigh on consumer spending for the next few quarters. The decline in activity should have the intended effect of taming inflation. So the decrease in the housing market is one thing that will help tame inflation.
Which is why the Fed went after the interest rate as a way to tame inflation.
And remember, it affects all borrowing and spending too.
It does.
Because if your car costs more money to buy a new car or credit cards, you try to spend less money, and then it affects everything.
Right, but the biggest loans that people have are vehicles and real estate, and interest rates, raising interest rates impacts the interest rates that you pay on those particular things, and that's the biggest lever that the Fed has to pull regarding trying to impact inflation.
Yeah. The next one is very interesting. Thankfully, the risks of a deep housing-led recession of the type experienced in 2008 are low. First, housing construction was relatively subdued for much of the last decade. We have 5 or 6 videos on this, which means we are unlikely to see a glut of oversupply driving home prices materially lower. Second, those that have recently bought at higher prices were still constrained by the bank's more stringent loan-to-value and loan-to-income ratios. I'm going to say right now, whoever wrote this watches our channel.
Yes.
I bet if you go through our thing, we said those exact words.
And we've said them probably at least 100 times at this point.
Okay.
Yes, because like we've talked about before, the loan qualification requirements are much more stringent than they used to be. People are putting more money down, so that's providing a lot of support for the real estate market because people have equity in their homes and people were well qualified buyers when they entered into that loan.
Okay, here's another thing that we're going to throw up. Finally, the impact of higher rates on mortgage holders is likely to be less severe. So if you're already a mortgage holder, in the U.S., households did a good job of locking in lowest interest rates experienced a couple years ago. Only about 5% of U.S. mortgages are on adjustable rates today, compared with over 20% in 2007. In 2020, the 30-year mortgage rate in the U.S. hit just 2.8%, prompting a flurry of refinancing activity. Unless those individuals seek to move, their disposable income won't be impacted by the recent increase in interest rates.
Not only that, but they're not as impacted by inflation either because their wages are going up, but their biggest household expense, which is their house payment, has remained constant and it's relatively low because they've got those low interest rates.
The most interesting thing about this, I think, is that this sort of goes along the line of, these people that bought are not subject to this rising rents that we've seen.
They're not subject to rising rents. They're not subject to the higher interest rates. They're not subject to higher housing prices because that's the point of buying a home, right? You get to lock in that payment and be able to control your housing budget.
Okay. The next one was Morgan Stanley Investment Management. Another company does the exact same thing as that everybody else does, right? This was their headline. We see a resilient economy without a looming collapse. I think that's pretty interesting. They didn't specifically talk about single family homes. They talked about REITs, so we grabbed their REIT data because it's like a comparative market. Okay. The stabilizing interest rate environment expected in 2023 should bolster real estate investing. So they see stabilizing rates in bolstering real estate. While U.S. REITs have historically underperformed U.S. equities during periods of large interest rate increases, they've outperformed 3, 6, and 12 months after a significant rise in interest rates. So they're literally saying that real estate has done the best 3, 6, and 12 months compared to U.S. equities. But as you know, U.S. equities got pretty hammered this year.
They did. So I question that a little bit because equities got hammered. Real estate has been kind of rocky this year, so I kind of question all that. But we'll give them their due. Moving on.
Yeah, okay. So I don't know what analyst wrote that. Okay, here's the next one. This is the one I like. This is my favorite one. Contracted rental streams with inflation-linked escalations and the necessity-based nature of real estate, meaning you have to have somewhere to live, coupled with limited new supply additions due to rising construction costs, may portend limited downside in real estate cash flows, meaning there's no downside that people invest in real estate will get less money in the future because there weren't a lot of new homes built and rents are going up.
Right.
And why are rents going up?
Well, because vacancies are down. Vacancies are really low.
Lowest since when?
Vacant homes in general, not necessarily vacant rentals, but vacant homes are the lowest since like 1970 something. 73,
Yeah.
and then the time before that was like 1957.
Yep.
So the overall vacant residential housing market is very low, and then as far as rental vacancies, those are really low as well. So supply and demand, there you go.
Okay. The next one, we expect mortgage interest rates to decline in 2023 from their 2-decade high as spreads narrow from their 2022 wides. This actually, they were one of the ones that did predict a recession. Mm-hmm. But they're still saying they expect mortgage interest rates to decline. One, how would that affect the housing market if mortgage interest rates decline?
So if mortgage interest rates decline, people are going to come back into the market and they're going to find that home and purchase it. Sellers will, that need to sell the house because they're moving out of the area or whatever's going on in their lives will sell. But I think inventory is still going to be probably pretty low because people who have homes that are paying 2-3% in interest, they're going to be very hesitant to relocate to another home and sell this one because on the purchase side, they're going to be paying twice as much in interest. So I think there's going to be a little trepidation on the part of sellers to sell their existing home because of their interest rates.
Yeah, I definitely think if interest rates stay relatively high compared to what we've seen, there are going to be some people who have regret that they didn't go buy a house or a bunch of houses or do that refi because, I'm going to wait till they go down to 1.5%, then I'll refi, right? You get those every year. Okay, the next one's Citi. Citi, as you know, is another investment firm, bank lender, etc. Their headline, how unstoppable trends are redefining real estate. That caught my eye. Unstoppable trends. I thought, okay, this is going to be bad. So here was the first paragraph. Amid macroeconomic difficulties, long-term forces are continuing to create potential opportunities within real estate.
There are always opportunities if we're willing to see them, right? So what are the opportunities? What are they talking about?
Okay, first one, we see some areas of real estate as better placed to cope with inflation.
Yes.
Because there's no guarantee we won't have some inflation for a while. Like the Fed, we may get to 2 and 3%. The Fed may just let it kind of tear.
Yeah, I mean,
they may say, hey, look, we're not going to raise rates, but we're not going to lower them either, as long as we have 2.5%, 3% core inflation, not total inflation, because we have energy costs which are volatile and we don't have a lot of control over those.
Well,
we could, but
it's a different discussion.
Okay. This was the next one. This was the negative one. Okay. We'll put this chart up. Now, this is apartment rent versus a mortgage payment. Mm-hmm. So these are not renting a house. Mm-hmm. Now, if you look back, it goes to 2015. You can see there's anywhere from a 200 to a 400 gap. It's cheaper to rent an apartment than buy a house.
Right, but it's cheaper only on the front end, not on the back end. Remember that, because on the front end, yes, every month you're spending maybe less to rent an apartment than a house. However, if you are purchasing a house, that extra couple $100 is actually money that goes into your own pocket because you're building equity in your house, and then you get to probably deduct that interest payment against your income tax, and then you get to deduct property taxes and things like that. So at the end of the day, when you're looking at it on an annual basis, even though it's cheaper on a monthly basis, on an annual basis, actually it's still cheaper to own a house.
Okay, this is the interesting thing about this chart. If you look back at 2020 and you look at the mortgage payment, that little green area there, it looks like it's maybe at, I don't know, 1,700 or whatever. But then if you go all the way to the right for apartment rent, in the last 2 years, if you had bought a house in 2020, your mortgage payment would be less money than rent on an apartment. So this is what one is talking about. It would be fixed. It wouldn't go. It doesn't mean it's going up. That's it. When you lock in that rate, that's what your payments could be. It's not ever going to go up if you get a fixed rate loan, which 95% of people do. But rents are going up. And if you look at that blue line, rents are going up the whole time. Mm-hmm. And you're not insulated from that. Basically, if you had bought a house at any time prior to 2020, you did exceptionally well. Yes, right now it's substantial because mortgage rates are higher. But if you look all the way at the top and you see it's starting to decline, that's because interest rates have backed off a little. So the spread is still there. It's interesting, though, to see, though, as that spread gets closer, how that'll incentivize more people, which is sort of our thesis that is it gets closer to being more real. Okay, I have to pay $500 more a month to own a house, but then if I have this payment for 30 years and I'm building equity too, because this also doesn't include you're paying down principal,
right,
and doesn't include future appreciation.
Correct.
Right. Okay. The next one was Credit Suisse. They were definitely negative. Okay. We expect the environment. Now, this was national. I mean, this was worldwide.
Okay.
They were copying globally. Okay. We expect the environment for real estate to become more challenging in 2023 as the asset class faces headwinds due to higher interest rates and weaker economic growth. We favor listed over direct real estate and still prefer sectors with strong secular demand drivers. So the key here is that in their report, they basically had the two top parts of the world where real estate was the best, and the U.S. was second. It was second best. I think it was the U.S. and Europe were the two top, and then China was the worst.
Okay.
China was like the worldwide. They were like they broke the world out into like 7 categories. The U.S., UK was one, Europe was one, Asia was one, China was one, and Australia was one.
Right. Well, but China's had difficulties with these ghost cities and that sort of thing. So, and remember they're a huge market, and so what happens there has an outsized effect on the whole global market.
Yeah. There's a whole big thing I'm going to put up. You guys can read it. I'm not going to read the whole thing. It's a lot. But here's the interesting thing, because they did talk about office and retail. And we're really only concerned with residential. But this is what I thought was interesting, where I put that little red line. On a positive note, rents can be indexed to inflation or increased by a fixed amount during the lease term, providing a partial hedge against elevated inflation.
Right. So, I mean, look, if you're familiar with the way the rental market works on the residential side, you know that your apartment lease is for 6 months to a year. Your house lease is probably for about a year. So every year your rent gets adjusted, and that adjustment is part of what is, the inflation is part of what's considered in that adjustment. I just renewed a lease for somebody, and I raised their rent, and it was not an insignificant amount, particularly at that price point. So, and their thing was, well, what's up with that? And I said, well, 2 things: 1, inflation, and 2, there's nothing even close to this on the market that you could go and move to. So you're still at or below market level, so you're still getting a good deal. Now, it's a good deal both ways. The tenant gets to stay in the place, doesn't have to move, and gets a really good rate for rent. It's a good deal for me because I don't have to take back the property, paint it, renovate it, have it be empty during that time when I'm not collecting rent, and then go out and get a new tenant. And that new tenant is an unknown. I don't know if they're going to pay me rent and all of these things. I've got a known quantity with this tenant, so it's a win-win situation.
Are you seeing anecdotally, people staying put as tenants versus trying to move versus 3, 4, 5, 7 years ago?
They're definitely staying put.
Right. Very low tenant low tenant, this is why it's great. When you're an investor and you own a rental property and your tenant, you have getting a new tenant every year, you potentially have a month of no collecting any rent because you're cycling out people. And so sometimes you give like a discount on the rent just to get them in there. You say, hey, I need you in because I need to start collecting money. But when they don't leave, that's like a super win. So sometimes a good strategy is you may be able to raise rent $200 in 1 year, but you'd say, hey, I'll raise your rent $100 instead of $200 if you'll agree to stay for maybe 2 years and then whatever. Like sometimes it's worth it having a tenant in there, right?
It is worth it, but I don't give them that much of a break.
You don't give them that much of a break. She doesn't do that. She's pretty tough. They predicted from the peak 15 to 20% total, which would still be an increase if it went all the way to 2024, would still basically be an increase over a 3-year period. So it basically, if you looked at a chart, it would be prices are going up, this huge shout out, and they come back down to where they were 3 years prior. 15 to 20%, which is kind of interesting because that's sort of what the other ones predicted, 15 to 20%. 20 at the high end, 15 was sort of low end. Deutsche Bank. Deutsche Bank, they were the next one. Of course, they're global. We're going to start with the GDP growth forecasts. So this was for, if you look at this chart, 2023, we're at the top, US 0.4. They're actually predicting growth. They predict overall growth for the year. Now remember, you can have quarters of negative growth, but for the whole year, they're predicting growth. That's great. We actually outperformed the rest of the world. They do have a high percent for China, but remember, China's been growing at 8% a year prior to COVID.
Right.
They got crushed this year.
And if you look at this kind of makes my point that I made earlier, that what happens in China has an outsized impact on the world. Their 5% all of a sudden raises the world economic outlook by a substantial amount because everybody else has substantially less than 5%.
Yeah, but what's interesting though is in 2020, China performed the same as the Eurozone, 3.2, 3.3%. The Eurozone's predicted to grow at 0.3%, which is 3% less, and China's almost doubling. They're going up to 5%. So but remember, China normally, if this has been a normal year, 2022, it would probably be 8% growth for China. China has been growing at larger percentages for years because they do have more of a developing economy.
Right.
And a larger population.
And they have a cohesive plan.
They do. They have a cohesive plan, and they have central planning and things like that. And so, but I just thought this was interesting. And of course, the rest of the world pretty much is kind of like, not is below this. China looks like they'll be the leader in 2023, but the US 0.4, that's good. It's better than zero or negative, right? Okay. This is what they said in the thing. A soft landing is possible in the US as well, with a marked economic slowdown so far not resulting in any significant increase in unemployment, and still a large number of unfilled vacancies. That we talked about this. We have twice the number of openings as we do job seekers. Growing evidence of a slightly downward trend in inflation in the U.S. could see Fed refocusing increasingly on economic growth, with further increases in the base rate likely to be smaller than the recent past. So what this says to me is that I believe, and everyone else believes, we're past the hump. Like the worst potential fear that we weren't sure about in January, February, March, that we've kind of allayed a lot of that. Like that we were afraid we'd have 8% inflation for like a year, and it didn't happen because core inflation's down substantially.
Right.
Because even when inflation was over 8, the core was like 7, but now it's down a lot. Right. And remember, there's a lag time for these interest rates. So the higher interest rates will keep driving, even if they don't raise them, will keep driving down core inflation. And that affects real estate.
Right. Yeah, so long as nothing crazy happens, well, it'll all be good.
Okay, here's their take on real estate.
Okay.
Real estate illustrates the risk and opportunities involved. Rising interest rates in 2022 have challenged the upward movement in prices in the global residential real estate market. In the U.S., for example, mortgage interest rates are at their highest level in more than 20 years, and the number of houses sold had fallen by 30% since its peak in 2020. However, persistently high demand for housing could increase further in the next few years, and vacancy rates in the U.S. are still at a historical low. Finance and construction costs are all likely to hold back supply, meaning the price of new build residential property is not likely to fall by any significant amount in the near future. They watch the channel. That's how they got that. They watched our channel and then wrote that down.
There you have it.
I mean, we've been saying that. They've been saying that. We have the lowest vacancy rate we've ever had. And, construction costs are so high, so we're not overbuilding.
Right. No, I know I make fun, but it's true. I mean, this is exactly what we've been saying. What's the next one?
Okay, the next one's Fidelity. Challenges ahead, but with potential opportunities.
Opportunities. Let's talk about opportunities.
Let's talk about opportunities. Against a volatile economic backdrop, the real estate market focus is shifting towards the ongoing cash flow available over the next 12 months. As the tightening cycle slows and rates stabilize, however, opportunities should begin to emerge for investors prepared to take them.
So cash is king?
Cash is king. We're going to throw up the chart and I'll read it. The coming year is likely to be a challenging one for real estate. And this is a chance to lock in higher yields, generate long-term value. Signs of recovery in the wake of higher lending rates could seem elusive in the first half of 2023. Private markets are not as liquid as their public counterparts, and as their pricing trend can lag other asset classes, they may continue to decline over the first 2 quarters of the coming year. Yields will rise further to reflect tightening financial conditions, but we don't expect a cycle like that of the 1990s, nor that prices will sink to the lows of the global financial crisis. So they're saying there's pressure, but that's it.
Yep.
And then they can just read the rest of it. I have one more slide that we're going to throw up,
Okay.
and then we'll wrap it up.
I like it.
Okay. I apologize for the long video, but there's a lot of data. Like, it took us hours to go through this to make this video, so you're going to make you sit through it. Instead, we expect the upcoming cycle to be relatively short. That's good news. Because I think that's what the people are predicting is, we're going to have 5 years of this like we had last time. And if everything decreases at 7% a year for 5 years, that's 35%.
So here's the thing. The way the technology is going and the way the economy is going, that's physically not possible. The world is moving at a much faster speed in all aspects. So the idea that we would be in this stuck place for 5 years is absurd.
Yeah, I agree. If interest rate levels begin to stabilize, not go down, but stabilize, we believe that most valuations will readjust by the middle of next year. As the market moves closer to the bottom, there will be some interesting opportunities for investors with long-term capital to deploy. We literally said this, that there are funds raising money to go buy more houses. The number of homes on the market right now, about 1.2 million, is still almost a third of the historical number of homes that are available to purchase in the U.S. each year. This is one of the reasons why home prices keep going up. You have these people locked in who never sell real estate. Like, your average person does not buy a house thinking, I'm going to sell it.
Right. I mean, it used to be that people did do that. People would buy a house and say, okay, in 5 years, I'm selling it and I'm getting the next move-up house and so on. So that used to be the way people dealt with real estate. Things have changed. People are staying in their homes longer and longer. The idea that people would stay in their homes for 30 years was really relatively unheard of. But just on our own street, half the people on our own street have been in their homes 30 years or longer.
Right. And the other thing I've noticed too, this is anecdotal, more people I know than ever own rental properties.
Yes.
And almost all of them, they're not super rich people. They're workers, they're people, they're airline pilots, people like that. They went and bought a house. And then when they did the move up to the bigger house, instead of selling the first house, they turned it into a rental.
Right.
So it never got to go out into the buyer pool. It just became a rental.
Right, which serves an important function in society because people do need rental homes.
Yeah.
All right, so the cliff notes. The cliff notes of the video are really short, sweet, and to the point. Inflation, not a big concern for 2023.
Nope.
Unemployment, not a big concern for 2023.
No one's predicting it.
Interest rates regarding mortgages, they're pretty much where they're going to be. They might go up a little bit, but not much. The Fed may start to stop raising interest rates probably sometime in the second quarter, certainly by the third quarter. We don't think that that's going to continue, and we'll start focusing on growth. Did I miss anything?
Chance of recession, a little over 50%, but no one's predicting a massive multi-year recession. Very short recession, turn right back into growth. Opportunities, they say second half of the year. I think it's going to be before that. I think that the market's going to pick up in the spring nationally. We're going to find out though. Okay.
So if you like the video, please share the video, like the video, subscribe, hit the notification bell. Please leave us comments and tell us what you think. This was a lot of data. I know it's a long video and it was really complex. So take your time, leave us long notes. We'll read them and we'll respond. Have a good weekend. Bye.
Bye.